Hi everybody. In the last video we talked about pension plan assets. In this video we'll begin our discussion of periodic pension plan expense. Like wages, salaries, commissions, and other forms of compensation, pension expense is part of a company's compensation for employee services each year. Accordingly, the accounting objective is to achieve a matching of the costs of providing this form of compensation with the benefits of the services performed. However, the fact that this form of compensation actually is paid to employees many years after the service is performed means that other elements, in addition to the annual service cost, will affect the ultimate pension cost. These other elements are related to changes that occur over time in both the pension obligation and the pension plan assets. Illustration 17-11 in your textbook provides a summary of how some of these changes influence pension expense. We've examined each of the components of pension expense from the viewpoint of its effect on the PBO or on plan assets, using global communications as an example to demonstrate that effect. Now let's expand how these changes affect pension expense. Before moving on to the calculation of pension expense, however, let's look at the additional assumptions we must consider in connection with the global communications example. Assume a prior service cost of $60 million was incurred at the beginning of the previous year, 2020, due to a plan amendment increasing the PBO. Also assume that at the beginning of 2021, Global had a net loss of $55 million. Previous losses exceeded previous gains. The average remaining service life of employees is estimated to be 15 years. We will use these factors as we begin our calculation of pension expense. This illustration demonstrates the relationship between some of the changes in the PBO and in the plan assets and the components of pension expense. Those are service cost, interest cost, the return on plan assets, prior service cost amortization, and net gain or loss amortization. We will look at these 5 components of pension expense one at a time. The $41 million service cost represents the increase in the projected benefit obligation attributable to employees' service performed during 2021. Each year, this is the first component of the pension expense. You have already had practice in calculating the current year service cost. If you're unsure about this calculation, you should watch video lecture 17.5 again. The interest cost is calculated as the interest rate or discount rate multiplied by the projected benefit obligation at the beginning of the year. In 2021, this is 6%, that's the discount rate we've been using in all of these global examples, times $400 million beginning balance of the PBO, which equals $24 million. The PBO balance is not separately reported as a liability in the company's balance sheet, but it is a liability nevertheless. The interest expense that accrues on its balance is not separately reported in the income statement, but instead becomes the second component of the annual pension expense. Remember that plan assets comprise funds invested in stocks, bonds, and other securities that presumably will generate dividends, interest, and capital gains. Each year, these earnings represent the return on plan assets during that year. When accounting for the return, we need to differentiate between its two modes, the expected return and the actual return. Let me shortcut where we're going with this. As we saw in the previous video, we used the actual return to calculate the ending balance of the plan assets. When we're calculating our pension expense, we're going to use the expected return. Now let's go through a few slides to show you how that is done. Let's first discuss actual versus expected return on the plan assets. We've assumed Global's expected rate of return is 9%. So its expected return on plan assets in 2021 was 9% times 300 million, that was the beginning plan assets, or $27 million. But as previously indicated, the actual rate of return in 2021 was 10%, producing an actual return on the plan assets of 10% times the beginning balance of 300 million, or 30 million. Let me show you the slide on the plan assets so you can see the beginning balance, you can see the 9% expected return and the 10% actual return. Just a moment and I'll flip to that slide. Here's Global's PBO beginning to end of 2021. Here's Global's plan assets beginning to end of 2021. The beginning balance was the $300 million. Actual plan return on plan assets was 10%, and we multiplied 300 million times 10% when calculating the ending balance of the plan assets. But notice down here in the expense, we multiply the beginning plan assets times the expected return to calculate the expected return on the plan assets. That's the piece that we use directly in calculating the pension expense. We'll talk about what we do with the difference between the actual return and the expected return in a few minutes. Obviously, investing plan assets in income-producing assets, stocks, bonds, etc., lessens the amounts that the employers must contribute to the fund. So the return on plan assets reduces the net cost of having a pension plan. Accordingly, the return on plan assets each year reduces the amount recorded as pension expense, and that's why that's in brackets. Just as the interest expense that accrues on the PBO is included as a component of pension expense, rather than being separately reported, the investment revenue on plan assets is not separately reported either. In actuality, both the interest and the return on plan assets components of pension expense do not directly represent employee compensation. Instead, they are financial items created only because the future obligation to retirees must be funded currently. Your takeaway on this for now, as I've already said, is when calculating pension expense, use the expected return on plan assets, which will reduce the expense. Now let's look at the adjustment for gain or loss. There are two ways we can have a pension-related gain or loss. We talked about the first one a few videos ago. A gain or loss is recorded in calculating the balance of the projected benefit obligation when an estimate used in the pension calculations is changed. We saw an example of this when we recorded a loss on the PBO from when the estimate of the employee Pharaoh's salary in her final year of service changed from $400,000 to $420,000. That change running through our calculations in our example created a $9,155 loss on the PBO. And we used that loss on the PBO when we calculated the ending balance of the PBO. The other way we can have a pension-related gain or loss is when the expected return on plan assets differs from the actual return. Here, we had a $30 million actual return on plan assets, which was $3 million greater than the $27 million expected return on plan assets. Since the net cost of having a pension plan is reduced by the actual return on plan assets, you would think that the charge to pension expense should be the actual return on plan assets. However, the FASB concluded that the actual return should first be adjusted by any difference between that return and the return that was expected. So, as we've stated before, it is actually the expected return that is included in the calculation of pension expense. And in our illustration, Global's pension expense is reduced by the expected return of $27 million. The difference between the actual and expected return is a loss or a gain on plan assets. Although we don't include these losses and gains as part of pension expense when they occur, it's possible they will affect pension expense at a later time. Well, that's all for this video. In our next video, we'll discuss amortization of prior service cost and amortization of plan-related gains or losses. See you next time.